Welcome back to the Real Estate Standard, episode 7, where commercial real estate and Bitcoin come together. I'm your host, Tim Kotzman. Today's February 2nd, 2026. Each episode here, we try to break down how serious operators, investors, and developers stay competitive and profitable by examining commercial real estate through the lens of Bitcoin, the lens of evolving capital markets, and long-term financial strategy. On today's episode, we're diving into the state of insurance in commercial real estate with Garrett Johnston. First, we're going to go over to Kenny to give us an update on the West Main storage stacking.
Hey, Tim, happy Groundhog Day. I saw that the groundhog saw his shadow, so another 6 weeks of Bitcoin winter. Let me share my screen with you guys. We're going to go over the West Main self-storage dashboard. Today is February 2nd, and our total stack is 2.62 Bitcoin. Recap of January, we had an addition of 0.43 Bitcoin, so 43 million Satoshis. That's bringing our year-to-date Bitcoin yield to just about 20%. And our Bitcoin per square foot, currently at 3,774 Satoshis per square foot. And that's about 9 months of coverage on our mortgage payments. And then I have another special announcement. I'm just hoping you guys can see my screen here as I share this with you. But West Main Self-Storage last week acquired 2,014 shares of Stretch. So we've talked about on this show about digital credit and how the yields from that digital credit represent digital rents. And this is going to increase our income by $22,500 per year. That's about a 3% NOI increase, about $1,875 per month. And just to give some context there, that's the equivalent of about 6 10 by 10 storage units, 10 by 10 square feet storage units, or 15 5 by 5 climate controlled storage units. So we're building in cyberspace, adding storage, more storage income that's going to be treated a little bit better with the ROC dividends there. And I'll kick it over to you, Chris. What do you think?
Congratulations. Not only did you stack the dip, but you are adding units and adding, square footage in cyberspace. That's a huge accomplishment. So the commercial real estate folks out there, they're always trying to look at creative ways to either add an income stream and or add square footage. And, you were able to do both that in a way that is uncorrelated to the local real estate market and the broader real estate market. So I think that is fantastic, and it just goes to show that you're building a very robust and resilient asset here with this strategy. And it was funny over the weekend just watching Twitter and all the price action in Bitcoin with all the commercial real estate bros coming out. The commercial real estate Twitter is hashtag retweet. And to see everybody come out and just start dunking on Bitcoin was, it took everything in me to, not get involved in the mudslinging. I just wish, real estate guys, they understand long duration assets better than most. And I wish they would, look at Bitcoin the same in the same lens. And I think what you're doing here with the stacking update and some of these Bitcoin specific metrics on West Main are demonstrating exactly that. So good for you and congratulations. Over the weekend, we did have Grant Cardone and Cardone Capital. They stacked the dip as well. You can check on Grant's Twitter profile. He announced that they had bought $10 million worth of Bitcoin at the price of 76,000. So they were able to stack just about 131 more Bitcoin for their new hybrid fund. And if I'm not mistaken, I believe that is for the apartment complex in Boca Raton, Florida. So if any of that is on your radar, go check that out. And kudos to Grant and his team for not only entering the market, but letting the market come to them with this buy. I think you had mentioned that the limit price had been in for multiple months. So that's exciting to see it all come together for those guys. I'm really excited to have Garrett here today. In the commercial real estate space, for the last 15, 20 years or so, admittedly, insurance has been an afterthought. It's not something that's on the forefront of people's brains when they're transacting a deal, and it was kind of one of the last to do items on your list. Whether you were acquiring a property, whether you're an operating existing asset, or whether you were moving a new tenant into a space and needed your general commercial liability. But that is no longer the case. The last 5, 6 years or so, insurance has been front and center across the industry. We have providers leaving markets. We have premiums through the roof. Deals are dying, particularly just because of insurance. So we have a lot to unpack here, Garrett, and appreciate you spending some time with us today.
Yeah, happy to be here.
Maybe why don't you start? I know we're all familiar with each other, but why don't we start with just your background? Give the audience just a little understanding of where you're coming from and the vantage point you have in the industry, because I think it's incredibly valuable.
Yeah, so I'm a lifelong large commercial insurance professional. I started in the business in 1999. The first half of my career, I spent almost exclusively in the kind of financial institutions, banks, private equity funds, large commercial lenders, large residential lenders. So really kind of the TradFi rails of insurance. I had a stint where I handled a lot of what we refer to as like sharing economy, so kind of the Ubers, Lyfts, and DoorDash of the world. And then personally, I went down the Bitcoin rabbit hole 2019. Took special note of Michael Saylor when he started buying at Strategy in 2020. And ever since then, I've been really, really focused on that intersection between Bitcoin and traditional financial markets. And that can be anything from asset managers, banks, lenders, mortgage companies. And then what I'm finding more and more is into the commercial real estate realm of, to your point, like Grant's a perfect example of. Cardone Capital is just one of the newer versions of an integration of a Bitcoin strategy into traditional commercial real estate. So one of the things I look at consistently is, and as somebody who is, when I look at the space and when I go to conferences, I kind of feel like there's generally two buckets of people that attend these events. There are what I would kind of call the OG Bitcoiners that have not necessarily spent time in a corporate commercial space. And they're going to have one view of the world. They're going to be a little more on the spectrum of kind of the cypherpunk property rights. They get a little bit bent out of shape when the latest version of hyper Bitcoinization comes in with treasury companies. They cheer Sailor on, but they're not quite sure this financialization of Bitcoin kind of goes against their cypherpunk ethos. Nothing right or wrong with it, but that's just one part of the spectrum. Then I think there's a whole nother cohort, and this is where I personally run into a lot of folks in the Bitcoin treasury space, is traditional operators, right? An insurance guy, a real estate professional, et cetera, that discover Bitcoin and then really start thinking about, I've got a saying I always tell clients, like, you don't have to ditch your traditional industry and go all in Bitcoin. Bitcoin will make your existing industry better if you just allow yourself to think through some of the frictional dynamics and what Bitcoin can do, particularly, longer duration investors and asset holders, Bitcoin is far better for. So certainly like life insurance is a perfect example of long duration liabilities that's just ready and waiting for a Bitcoin treasury strategy. There's a lot of regulatory issues that prevent that at the moment, but we're moving in the right direction. In the real estate piece, one of the things I've really been spending some time thinking about, so in my role, my unofficial title that I always tell people is like, I lead Bitcoin strategy within Marsh, right? So Marsh is the largest global insurance broker in the world. So they do the insurance, but then also within that firm, they have sister companies of Mercer Investments, 17 trillion under advisory. They are the number one third-party investment consultant that pensions, sovereigns, et cetera, large capital allocators use to determine, should they invest in the 60-40 portfolio? Should they put a little bit in commercial real estate? Should they put some in hedge funds? Should they put some in Bitcoin? So we have that piece. And then we also have the Oliver Wyman side, which is really like, it's the McKinsey, non-insurance, just business consulting. So I get to see a super wide variety of, I work on Bitcoin miners transitioning to hyperscale data centers and building out, $5 billion dirt up data center projects, right? I work with large insurance companies, large commercial lenders, sharing economy platforms, et cetera. So I see this broad space. Within the commercial real estate, one of where I'm really starting to kind of intersect is, and kind of to this, I'd love to get some of your feedback, both Kenny and Chris, is, this advent of digital credit that Saylor came out with roughly a year ago is just so vastly misunderstood or underappreciated of the power that is going to create. And I think of where we're heading of layers of infrastructure where you need to understand Bitcoin first. And there's a lot of people that's a hard road, that first $100 to understand Bitcoin, before you can even have a chance of understanding strategy, right? Then you have to understand strategy and go down that rabbit hole. Then you have to go down the digital credit rabbit hole. And if you don't understand those three, and that's a lot of, that is a lot of hours to get to that point, right? If you've not gotten that far, then taking that next layer and how are you going to use digital credit products, both Bitcoin and digital credit, right? Because Bitcoin to me is like the asset, like the property, but then digital credit is like the rent rolls, right? The net income that comes off of that. And with the stretch products being, double-digit returns, the amount of businesses and arbitrage that you can do in the lending space or traditional trapped equity, whether that's in whole life insurance, that can be the secondary mortgage market, that can be the commercial real estate market, I view as just woefully underappreciated how vast that pool of capital is and how much the game is going to be changed by integrating Bitcoin, but also integrating some of these digital credit products like Stretch into the mix. So I'm going to make kind of an observation I've had the last few days, and I definitely want to kick it back over to Chris and Kenny because I think we can use this as a bit of a dialogue. To your point, Chris, insurance is like taxes. Like, people do not want to deal with it. Like, they just want it to be done quickly, make it go away, and get off my plate so I can focus on the core business. But just like taxes, insurance is something that can benefit the business, and it can also work against you if you don't manage it well. So, when you look at the core operations of a commercial real estate investor, you're looking at net operating income really determines what you can get loans against, right? So it's net operating income and then debt coverage service ratios, right? Like, those are, to me, like your two key metrics. And this is, I will say, a statement that's kind of a question back to you guys because you're more the real estate pros. But we're always working with clients, and a lot of them might be 10,000, 20,000 unit multi-tenant commercial real estate clients. And how can usually we're getting the calls usually when they're very frustrated that, let's say, they're California based or they're Florida coastal, and they have their insurance rates are either getting non-renewed, going up 20, 30%. So when you bake the insurance line item, it can crater your NOI, right? Which is going to have impact on what your debt covenants are and how much you can lend to flywheel the business forward. But if you can save and manage that cost, it can be an enabler to the real estate flywheel from a lender perspective. Where I think the current friction arbitrage opportunity is in the real estate space is the education gap, right? So part of what I love, I do a lot of these podcasts, and what I think is so important about them is, even though we're early, like, that education journey to get the broader ecosystem aware of these intersections is exactly what we have to do as a community. And Saylor does such a good job of pushing that narrative, right? So within that context, I would love, my understanding as it sits today is that one of the frictional problems within a commercial lender is they will give you full credit for your rent rolls, right? So as long as you have leases and contractual rents, that counts towards your net operating income, right? Which for the audience, like, correct me if I'm wrong, guys, net operating income is gross rents. But is it before
Minus your
deductions
operating
for
expenses.
expenses? Where does insurance fit in? Does that come into the NOI or come after it?
That is part of the
That's an
NOI.
expense.
That's an
Okay.
operating expense.
Okay.
So we would say that's above the line.
Above the line. Okay. So how you play your insurance can affect your NOI, right? Plus or
Absolutely.
Big
minus,
time.
right? Okay. So we get into that conversation a decent amount of, usually it's on the flip side of the property managers are very frustrated that their insurance costs are kind of creating their NOI, and they might be in a situation where they're looking to refinance or grow their business, and the insurance is like the fly in the ointment that is making the NOI, they're trying to get from A to B, and that's just a friction point they're having a hard time overcoming. So what can we do around that? There's obviously scale helps. But there's also all of these off-balance sheet things you can do through captives, offshore, alternative risk transfer vehicles, which as you get bigger, those things open up. And that's something that Marsh spends a lot of time, and I spend a lot of time walking clients through the pros and cons on. The lenders right now, to my knowledge, again, correct me if I'm wrong, they do not, and let's take Bitcoin and digital credit to the side for now, but they only give credit on when they do their lending ratios, only credit for contractual rents. They don't give credit, even if let's say you took 50% of your net cash flows that spun off the property and you bought, safe investments of US Treasuries, whatever they would deem to be the risk-free asset. They, for the most part, don't give you any credit for that that income as far from a lending framework standpoint, which to me it's strange, right? When I look at it from a first principles standpoint, the thing I always think in my head is like like your kind of run of the mill, like 10 to 20 unit strip mall property, right? Would US Treasuries that, spin off 4%, let's just say 4% net operating income for holding those, are those safer than a nail salon or a laundromat tenant that, from a credit default exposure of your underlying quality of rental income, that to me, just on first principles, I if I'm a lender, I would rather take the Treasury than the nail salon. But that's not how the lending markets work, right? Lending markets will say, no, I'm not going to give you coverage for Treasuries. So there's in some ways a broken incentive structure for the lenders where, again, like, I'm a big believer that like credit quality should rule the day, period. So Treasuries should trump the laundromat. But then you get into digital credit. So I love this idea, Ken. I think you were the first kind of that I'd heard it from surface, is this idea of digital rent, which you're doing on your own business, right? Which you're taking that rental income, you're buying Stretch, and then you're creating additional operating income from the Stretch dividend into the business, right? You're a little stuck right now,
Yep.
I'd imagine, because the lender's like, that's awesome, but it doesn't help you at all as far as what your loan collateral looks like. But in theory, would you rather have Garrett's nail shop in your space or Michael Saylor's Stretch with 2 years of interest reserve in cash on balance sheet? I would take Michael Saylor's credit quality any day of the week over a small business owner, right? So that's something I feel is a narrative that, to the extent I can help manage that, educate, etc. I think that's where the world is going, right? So I'd love to just pause there and get your guys' thoughts on this concept of digital rent. Are those lender wrinkles that I've kind of uncovered, are they the same from your chair? Because you guys are coming at this from a different angle than I do.
I'm gonna let Kenny go because this is music to his ears. You just hit on a topic that has been reoccurring here the last couple of weeks. So Kenny, I know you're exploding with comments here.
Yeah, no, like this is what I find really exciting, and I've spoken with Garrett a few times offline here, and he's one of the few people I've encountered that like understands it completely. Like, I feel like I'm going a bit crazy when I talk about this stuff, and to hear somebody else be able to think the same way and unpack it is as great as Garrett did, and he hit the nail right on the head. As a commercial operator, we also operate a portfolio of retail shopping centers and some other self storage facility. And at some of our other properties, we have other types of income. We have a cell tower that spits out rents. We have a seasonal tent that is set up in one of our parking lots for fireworks. We have solar panels on our roof, and these incomes, they're part of the net operating income. And when we talk to our lenders, they just include it. But the fact is, with the digital rents, they're being viewed as a non-related income stream. They're being segregated when it should be an ancillary income stream, because it does impact the operations of the business. And the way that it does that is it's tax deferred. So the the income is treated better than rental income. So this helps from an operational standpoint, where you can lower your taxable income. And this is what I think we need a lot of help in the industry, educating the existing insurance companies, the existing lenders, the banks, all parties really, right? And Garrett also mentioned that insurance companies are one of the largest buyers of private credit. So when I think of, okay, wait, the current lenders aren't getting this, like, how are we going to borrow against this income? Because net operating income, the way that it's valued in commercial real estate, there's a multiple, but the way that they calculate this is called a cap rate. And it's very misunderstood amongst people that are not in real estate, even residential real estate agents and brokers and stuff. They have a tough time wrapping their head around it, because the cap rate is divided by the net operating income. So if you have a 5% cap rate, you have a 20x. So for every $1 million that you create in net operating income, the value of that at a 5 cap rate is 20 million. So when you talk about eliminating insurance expenses, when you have an insurance expense that's in a policy that's tens of thousands or hundreds of thousands of dollars, that is eating into your valuation. And how you can compensate for that is doing things by adding Bitcoin to the balance sheet. Maybe insurance companies should be giving you a better rate, because you have like a retainer, so to speak. You have coverage for mortgage payment. You're de-risking the operation by having this bank account with Bitcoin. And then when you diversify your income streams, Garrett mentioned, would you rather have the nail salon or the hairdresser, the local hairdresser, that could botch somebody's haircut? Word spreads around town, nobody's coming back to get haircuts anymore. Or would you rather have a company like Strategy that has, I know with the Bitcoin moving around, they have maybe 30 years of coverage, of dividend coverage, that can withstand decades? Who do you think, like, is on the chopping block if there is another pandemic, and you have to be an essential worker or business to be open? Are people going to be getting haircuts, or are they going to grow their hair out like me and skip the haircut? The dividends are going to keep coming in, and it's I'm just going to pause there because I'm rambling, but I just agree with everything Garrett said, and I think he's doing important work, staying within a big insurance company like Marsh, and educating his peers, and doing the work from within. So I don't know if you
Yeah,
have any high level comments on that.
it's just that it's the irony of part of where I've read commercial lenders find comfort in the contractual rent is this dynamic of, okay, if the nail salon person doesn't pay, well, you can go chase them down in small claims court, right? Or, go after them from a credit standpoint. We all know that, I mean, that is such a hassle. That's a distraction from the business. Again, why not have stretch? And if stretch ever becomes a problem, you literally just close the position by SETA or whatever other flavor of perpetual preferred is out there. And you don't have to chase down that tenant. There's literally no distraction other than hopping on your trading desk and, executing a trade swap out takes you what, 3 minutes to do, right? So I just, to me, I just think that's where these products are so much more secure than tenants, right? And again, like the lenders will put a haircut on your occupancy rates, right? So if we go to like multifamily housing, let's say you've got 1,000-unit apartment complex, the lenders are going to look at you and they're going to say, here's your net operating income, but they're going to give you a haircut. You guys know better than like 5-10% haircut on occupancy
even
rate
if
to
the
handle
property's been
rollover.
100% leased for the last 5 years, they will just bake in a arbitrary
vacancy.
5% vacancy factor. I mean, in the last couple of years, that 5% has been increased a little bit depending on the property and the market. So you're exactly right.
Yeah. And if you replace that with digital rent, like again, like you don't have vacancy rate turnover, right? The consistency factor is just the credit quality is so much better. And then if we jump over to Bitcoin, I think the other part that's really misunderstood and where I think there's a huge opportunity to disrupt the insurance industry is this idea of collateral impairment, right? So you put yourself back in the large commercial lenders, they're going to look at Kenny's property, right? And they're going to do the basics like how well is it built? When did you last update the roof? What's the sprinkler system look like? What are what are those physical attributes? Where are you located? Are you in a floodplain? All because what they're looking for is like, is a storm going to knock Kenny out? Right. And from a lender perspective, they're always looking for that nuclear situation. A storm levels Kenny's things and Kenny's just like, screw it and walks. Right. Now the lender has to go try to take the rubble or the impaired property and close out their loan position, right? So they will buy insurance on the back end. We refer to that as mortgage impairment insurance. Very common in the real estate industry, right? So you take a Bitcoin strategy within a real estate portfolio, and all of a sudden you get to these examples where if you've got, let's just say 80% allocation to the property, like Grant, so if you look at like what Grant Cardone's doing, I think it is very interesting and kind of drives his point home of, and I'll probably be slightly off on the numbers, but directionally, this is, I think, where he's trying to land is like roughly like 80 to 85% of his private funds. So he does this inside a private fund structure, which gives him a little more flexibility, but 80 to 85% of his fund investments are the actual real estate, right? The Boca Raton properties. And then the balance is going to be Bitcoin, and he's using the cash flow off of, say, Boca Raton to buy more Bitcoin, right? So he's got this flywheel. But ultimately, let's just call it an 80-20 mix, right? There will be, like, if you just look at the math and assume a modest CAGR on Bitcoin of, say, 20 to 30%, right? Roll forward 10 years, from a lender standpoint, he's going to be sitting on, I have no idea what Boca Raton is. Let's just call it 200 million, maybe is like the property value, right?
Yeah.
That could be leveled and be worth nothing, but the 20% Bitcoin has grown so much, right? That the collateral, to me, like Bitcoin offsets the mortgage impairment dynamic in a lender mortgage impairment scenario. So like, particularly when you do, like what Andrew Holmes at Battery Finance does, same thing. Like he puts a tranche of Bitcoin into the loan package, and the Bitcoin as it appreciates, like transmutes the credit quality of that property
it
as you
lowers the
stretch
risk
out the
over
duration.
time.
Right. I think that's just completely lost on the lenders. And to your point, like Kenny, like the big money is usually like the insurance companies, the private credit market, the sovereigns, and the pensions. And so they're still very institutionalized. So they're going to be like, this is fascinating, Garrett, but let's see 5 years of data before we dip our toe in this pool, which is, you can appreciate where they come from because they have such big, like they have a mistake of that nature doesn't work well for them. So they have to be cautious by nature. But again, to me, that is where the once you understand Bitcoin, digital credit, and then how it intersects with some traditional industries like real estate, you see the inevitability of a Bitcoin bleed into real estate. Those real estate funds are just going to just flat out outperform their peers. No question. They might be a little more choppy, but you zoom out and you smooth out those curves, they are going to explode against their peers, right?
Well, this was something I was going to ask you because when you start going down the rabbit hole and you start, looking into this, you realize, am I going to have a tougher time educating the lenders, or am I better off issuing something like private credit?
Yes.
Basically what companies like Strategy and Strive are doing, but you're able to bundle the digital credit, which the yields from that are what I consider digital rents. So the question always comes, where's the yield coming from? And like people have a really tough time with the concept of financial engineering and the Bitcoin appreciating, like you mentioned, and they can't see the cash flow come in because it doesn't have, it just has the appreciation. So when you add in these digital credit products, those are the rent rolls, like you mentioned. And when you use that rent, you're increasing your NOI, you're increasing your income. So now you can buy more Bitcoin. So you can dollar cost average even more Bitcoin than you were able to, it's like a self-reinforcing thing because the more digital rent you add to your business, the more income you're generating and the more Bitcoin you can add. And so I've been going to get back to the question here is it going to be easier? You said it might be like 5 years before an insurance company is willing to do something like this. But if a real estate company were to add digital rents to their income stream and then
Mhm.
issue private credit, is this something insurance companies would be willing to buy and kind of jumpstart this digital finance?
I think eventually, yes. When you look at the total capital pool out there, I think where you're going to see this first move is going to be maybe in the family office ecosystem, right? Because they are much more nimble and they are much more long, like they can be very long duration. So, there's a number of family offices I handle, and like you see it generationally. Like I see a number of my family office clients where the dad that kind of made the initial tranche of money, and he might be in his 80s, kind of created the wealth that established the family office. But the son might be in his 60s, or the grandson might be in his 30s or 40s, and kind of be more of a Bitcoiner mindset, right? Those people. So I think generationally, like we're that whether it's Gen Z or whatever, but say that 30 to mid 40s crowd of young enough to kind of be digitally native and understand Bitcoin, but seasoned enough where they now start having decision-making authorities within family offices or larger firms. I see that shift. So I think family office capital, which there's a lot of money in the family office space. I think insurance companies, because they're so highly regulated, are going to be a little bit um, late to the party, but they eventually will get there. But they will want to see more time under the water under the bridge from a time horizon standpoint than your average investors. But that's where I think sovereigns have a lot of flexibility right there. So, and then where I think there is I predict there is a huge amount of capital on the sidelines, is from the companies that are already, very large, six-figure plus big, like there's a lot of high five to low six-figure plus Bitcoin companies out there that are not strategy, right? Um, whether they're stablecoin companies, whether they are operators that have been in the space for a really long time, but there is a significant amount of kind of Bitcoin centric, long time horizon wealth and credit out there that I think will start to lean into this space, and they will have the ability to be a little more flexible, a little more nimble than a bank. an insurance company. But just like, the banks and insurance companies, they will capitulate at a certain point. And I think it'll take the exact, like, the case study right now to me is the stable coins, right? The banking industry does not like the stable coins because they kind of encroach on their deposit base. And they don't like Bitcoin for the most part, but they're all starting to capitulate, right? And we're seeing the fight right now under the market structure to a large degree on kind of stablecoin yield. I think that's going to continue. And just Bitcoin into real estate, whether it's digital credit products or whether it's Bitcoin itself, is going to be the same thing. Like the large REITs or the large private equity real estate funds or just large multifamily owners are going to maybe kind of fight and kind of look, thumb their nose at stuff they don't understand and just keep trying to do the normal game. But they will ultimately be forced to investigate what this stuff looks like when they lose to a competitor that really leans into this and just like outpaces them by a long
We
margin.
have you're exactly right, Garrett. I mean, we have the education gap that is, very apparent to everybody. But, to your point, the numbers are going to speak for themselves in the not too distant future, right? You're going to have operators like West Main, you're going to have operators like Cardone Capital. They're going to print numbers that the
Right.
industry cannot even fathom, and it's going to grab the attention of the entire marketplace. Without getting too much into the weeds there, you just think about how big of a player insurance companies are in the commercial real estate markets.
Huge.
They
Yeah.
they have presence and holdings in every market, every property type, and those assets are spitting off 3 to 6% a year, maybe seven if they got a good deal.
Yep.
So, and this kind of comes back full circle to I thought where you were going with one of your initial comments was you think about the challenges that the operator, the real estate investor developer has day to day. And you think about the other side of the table with the insurance company, and they're kind of saying, looking at their book, saying, we have X number of liabilities on the balance sheet over this time horizon. We need to be able to generate this type of return over this time period. Where the heck do we get it? We're, a couple hundred basis points short, right? And, they're squeezing the consumer at this point to, try to get every last basis point. And you start to think critically and think creatively and differently via Bitcoin, via digital credit, digital rents. And all of a sudden, if your problem's not solved right away, you are much closer to solving that problem just by opening up this avenue in the real estate space.
Yeah, and I think part of it is how do you engineer the bridge? So you kind of got you got two sides of the Grand Canyon, right? And which side do you build from, or do you build at the same time? I think what's interesting is, and again, this goes back to my earlier comment of like some of the OG cypherpunk Bitcoiners have a hard time with those of us in the commercial space that kind of dress up Bitcoin and put it in the framework of TradFi. Like that doesn't feel authentic to Bitcoin. But like the reality is to get into larger pools of capital, you have to speak to the language in the regulatory framework that they exist in. And I'll give you a perfect example. So like Cardone's a perfect example of this. An insurance company, like all of us on this call who understand Bitcoin, if there were no regulatory downside, you could go to just about any insurance company's balance sheet that has long duration, which most of them do. And if you were to say, put just 5% of your balance sheet into Bitcoin, as long as the duration's over, say, 4 years, right? The performance of that insurance company's balance sheet and the loss ratios, they're all going to be massively improved because they have this asset at, say, a 25% CAGR on their balance sheet, right? The problem is, from a regulatory standpoint, it's a non-admitted asset and has this thing called risk-based capital charges, where you get absolutely obliterated as an insurance company. Same thing as a bank. If you put Bitcoin on your balance sheet, you almost instantly get downgraded by the AM Best and S&Ps of the world. So it's a non-starter, even though you could just, on an Excel spreadsheet, look at the math and be like, an asset with a CAGR of 25 on average over 4-year plus duration even if 5% gives you a far better risk-adjusted return than more treasuries, more hedge funds, et cetera. Now, where Cardone Capital is a very interesting arbitrage is they, like an insurance company, cannot hold Bitcoin on their balance sheet, but they can have private real estate funds as a portion of their allocation, right? So it's very common for an insurance company's balance sheet. It's going to be mostly treasuries, mostly kind of short duration, high credit quality, safe investments, right? But they, for an insurance company to put 5% of their allocation into private equity, right? Hedge funds, illiquid, high risk type of stuff. Same with the pensions, CalPERS, et cetera. Like that's very normal. And so what I think Cardone's interesting to watch is they are taking Bitcoin and they're wrapping it into a digestible wrapper that the large capital allocators are used to taking on, which is private equity, private fund risk, right? So an insurance company can get a derivative of Bitcoin exposure, but from a regulatory standpoint, they're still making an allocation to a private equity real estate fund, right? And kind of stay within their investment mandate. Again, I think that's all going to morph over time. I think once Strategy gets their credit rating to investment grade, because right now they're B minus, right? But if you just look at all their coverage ratios and stuff like that, they should be investment grade on the math. And I think Jeff Walton, Matt Cole do a great job at articulating that point. But as soon as that happens, like insurance companies can buy investment grade prefs, right? So once that unlock happens, so that might be 2 months from now, maybe 2 years, et cetera. But I view that as another inevitability. Like when that domino falls of the Strategy products become investment grade, there's a whole new universe of capital that will flood in to those products, right? It's going to be the same in commercial real estate. It's just, it'll be a journey on getting the people who determine what credit quality looks like kind of educated on board with it.
I want to ask you a question and maybe even pivot the conversation here a little bit, but I have been very critical about the existing inventory base across the United States. Basically, in short, saying that the majority of it, about 62%, give or take, is functionally and or economically obsolete, particularly because of its vintage. So 62% of the inventory base was built before 1990, right? Different era, different economic environment, different business models, all of it. And one of the challenges that we're seeing in the commercial real estate space today is the inability to improve those assets and bring them up to today's standard. Oftentimes, it doesn't matter how much money you're willing to throw at it. You get to a certain point where you're just better off, demoing, scraping the building and building something brand new. Okay. So my question is, and then bringing this back to insurance, and a lot of operators, having trouble renewing policies, getting coverage, all of that. A friend of mine and I were having this conversation recently, but are Class B and C buildings becoming structurally uninsurable in certain markets because of all these changes in consumer behavior and business models and demographics, et cetera, et cetera. I'd just like to get your thoughts on that topic, because it got into a heated debate.
Yeah. I mean, I think generally, like, real estate is hyper location dependent, right? So broadly speaking, I think yes. And then you're going to get into the nuance of the location risk dynamics. So hurricane zones, right? Old buildings that don't have the hurricane ratings or don't have the elevation of the first floor above the 100-year floodplain, stuff like that. And like, Florida is just such a perfect example of that issue. Is it's so flat. The amount, homes built 10 years ago have fundamentally different, they were built on different flood maps. And so when you see some of those large hurricanes roll through, it's a combination of windstorm, but a lot of the actual dollar damage that hit insurers is the flood, the rising waters piece in a coastal scenario. So if you've got a building that's 20-year-old code in a flood map that was no longer, that was not problematic at the time it was approved in zoning and now is in a 50-year floodplain, you know those are expensive to fix. You jump over to California, you don't really have the hurricane issue, but you've got exceptionally difficult wildfire and earthquake, right? Both of those things are um, very building code dependent as well, right? So, wood shingle roof in California, like good luck getting that insured if you're anywhere near an open space, right? Um, like 100 foot defensible space. Most people actually want, some shrubs and garden around their house. They don't want this clear cut dirt patch of 100 yards around their house. But that's what an insurance carrier would want to see from some of that. So yeah, you are seeing the frictional issues there. Um, and then you see the compounding effect of just the regulatory jurisdictional issues. So some states are notoriously anti-growth in their building codes. They just make it impossible to upgrade your home, repair your home, scrape it and replace it in an economical way. So I don't think there's any getting away from that. That is where, again, I go back to the reason it is so hard to insure is because insurers are dealing with the proverbial melting ice cube on their balance sheet, right? So if you just get back to first principle, if an insurer takes premiums, right, from homeowners, right, let's say in California, and they get X amount of money, well, then if inflation is running at 5-7%, they better be investing that at 5 or 7% just to stay above water, let alone LA County comes in with a new building code requirement of some sort that like completely, adds a 20% increase to the cost of construction, or a carrier pulls out, et cetera. So I just think it's very pernicious. And this is where, like, at a very high level thesis, insurance carriers need Bitcoin on the balance sheet to survive, period. They can't do it right now because the regulatory downside of the risk-based capital charge of putting it on their balance sheet, like it doesn't work. But that's where I spend a good amount of my time at the policy level too. So Marsh being as big as they are, we get invited in to talk to Treasury and others around, if they did this, what would that affect the insurance community to do? So I do get a seat at the table about every 6 months with certain policymakers just to work through these things of like, how do you do it? And I'm a huge advocate of we need, carriers are fighting inflation too. And you see it in the auto insurance is a perfect example too of like a fender bender on a current model. Used to be Teslas, but it's almost any of these cars that have a lot of these like self-driving modes, and the amount of cameras on a 5 mile an hour fender bender is now like a $10,000 repair job versus if you had like a 1990 Honda Accord, it's like $1,000, $500, right? Because it's just metal and plastic. There's no, I have one. I drive an old truck because I'm a Bitcoiner and like to stack my Bitcoin. My wife drives a nice European automobile, but I got a chip on my truck. I took it in. It was $300 because my truck's simple, right? My wife had the same thing. It was $3,000 because she's got cameras everywhere and sensors and all this stuff.
Well, and this kind of just
yeah, go ahead.
Sorry, this underscores, brings us back full circle to, the problem that digital rents is helping solve, right? I mean, we always like to go to, the improved superior return angle or conversation. Yep. But from an operational perspective, if you have this digital rent in place and you have, that additional income stream, you now can make those repairs when they come up, right? You're not skipping by. You have the ability to hold out for the right tenant when you have a vacancy. I mean, the concept of credit quality is well known and appreciated in the commercial investment space by and large. I mean, you get these cap rates that Kenny was talking about earlier based off the tenant quality, right? I mean, you have two perfectly similar buildings side by side, and one is leased by Amazon and the other one is leased by, a local business owner, the Amazon's going to trade at a 3 or 4 cap, and the business owner is going to trade at a 6 or 7 cap because they're viewed as, risky. So anyway, you solve a lot of the operational challenges. One of them being the increased cost of insurance, right? I mean, we were talking at the very beginning here about the operating expenses and just the overall annual increases in insurance alone, right? Well, what about electricity? I mean, depending on your market, I mean, you got electricity increasing 10, 15% a year, compounded over the last couple. So you can go through all these expense line items and have a real use case for implementing this digital rent, this digital credit, just from a standpoint of keeping the asset running in the black. Full stop.
Well,
Yeah.
I think what you said right there justifies digital rents as to be included in the net operating income because we talked about earlier on how this is kind of the ugly stepsister and how lenders and private lenders do not want to include this as NOI. But you just described that, hey, we can be more selective with which tenants occupy our building. We can increase the overall atmosphere and I think kind of going back to Garrett's analogy of insuring the different vehicles there, like I kind of wanted to back up even a little bit more. You mentioned about how the OG Bitcoiners, kind of have this different view and they look at it in a different lens. And I feel really like I was trapped on both sides when Bitcoin was released in 2009. I was 21 years old, and I didn't find out until years later when I was in my mid 20s. But being able to watch this whole gentrification is what I call it. I've been saying that for a while. Is Bitcoin's being gentrified, and the quality of the asset is going to improve, and it's going to affect how the insurance works for that asset for these things. And I think it's kind of ironic too. I kind of wanted to mention that Trump as the president, he was a real estate developer in New York and he gentrified parts of New York that were, distressed and low income, and just in bad parts of town where insurance might have been hired to coverage those buildings. I don't know how the insurance impacted, but I feel like it's so intertwined. The real estate and the Bitcoin are very similar, how you can look at these things and the progression of them. So I just wanted to jump in and say that.
Yeah, and I think it's indicative of any asset that is a well-performing asset. If it's in the fringes, it will naturally draw into the mainstream because it's a good asset, right? If Bitcoin was not a good asset, it wouldn't get gentrified, right? It wouldn't get pulled into the mainstream. And so to want it both ways of this will never be hyper Bitcoinization. Like it's kind of to me like it's unrealistic to think that we're going to scrap commercial real estate, right? And just buy Bitcoin. No, commercial real estate's not going to go away, but Bitcoin makes commercial real estate better. And I get back to my first principle. Insurance will never go away, but Bitcoin will make insurance better, more stable, cheaper, right? The other thing I wanted to touch on before we wrap is, again, along these kind of like, you look at how they do things and then you're like, well, why not Bitcoin or why not digital rent? So one of the other things I was looking at was when a property owner, and let's go back to the 1,000-unit multi-tenant apartment complex, right? So you're going to have your net operating income, you're going to have your cap rates. To your point, Kenny, if the cap rate's 5%, if I can save you $100,000 on your insurance, that 20x's to your purchasing power, right? Via the cap rate. So for every 100,000, if it's a 5% cap rate, you 20x your kind of lender metrics, right? So, and then I was, you look at what a lot of these large apartment complexes do. And this topic that I was reading about earlier this week was, and it's ironic because there's so much critique of Saylor of this financial engineering, which is kind of like given a boogeyman kind of vibe of beware, he's doing something sneaky, where he's just using math and being frankly quite brilliant on arbitraging, capital markets. Property managers do the exact same thing. So this whole concept of engineered enhancement to NOI and debt service coverage ratios, right? Well, you can do that without any investment by simply throwing laundry machines in that, create revenue, right? You can include pet deposits by allowing dogs, right? You can if you're renting apartments, you at the time of signing the lease, you can sell them renters insurance, right? And you can monetize part of that. So this I like that's also financial engineering. It doesn't have to be a boogeyman. It's simply a capex free way. You don't have to do a little bit of capex of putting in laundry machines that can swipe the cards or whatever, but like minimal capex for a much enhanced net operating income. And again, based on your cap rate, leverage flywheel that makes that stuff super attractive to do. So decrease expenses on just the property insurance. To your point earlier, like one of the tough parts of insurance for landlords in difficult neighborhoods is there's the property, but there's also the liability, because liability follows title. So if a female tenant gets raped on your premises because you didn't have security in your rough part of town or mugged or whatever, like those lawsuits ultimately can, again, like the deep pocket usually gets tagged in the lawsuit, period. And we see, it's a little bit of a diversion, but like there's this concept of nuclear verdicts in the casualty world. And we've seen situations where it wasn't Walmart, but imagine like a Walmart parking lot, a huge parking lot. Two dudes in a parking lot way away from it, like get in a shootout, right? But it's on premises, and there can be a nuclear verdict that the tenant, the landlord of that parking lot, is liable for a death claim. And it can be, it can be 20 million, 100 million, these crazy amounts. So there's just insurance is one of those things that they are left holding the bag from the plaintiff's bar. So the liability portion of any multi-family apartment complex, any kind of assault, battery, harassment type stuff outside of just this, slip and fall at the pool, right? There, you didn't have the tile done right, or there was a crack in the tile and there's a slip and fall. There's all sorts of liability stuff that comes out of it. So managing insurance is, again, just like taxes, not the most exciting thing in the world, but can have real dollar impact. And particularly when you start putting that against the cap rates, can work for you and can work against you.
I wanted to comment. I know that we're going to be wrapping up here in about 10 minutes, but I wanted to comment about again the financial engineering, because real estate, like you explained, there's financial engineering that occurs, and if you just look at raw land, that doesn't cash flow. That's an expense, right? It appreciates. I'd like to think Bitcoin is like the raw land, and the digital rents are coming from somebody that used their raw land to take building material, to like create building materials essentially, where what strategy and the other companies offering digital credit are doing, they're using their land to create materials that other businesses, where at West Main Storage we have purchased some of these building materials, and now we can use it at our property, and it can create a revenue for us. So we're literally using these as building blocks to be able to engineer. It's just that it becomes more tangible. I think the disconnect is when you can't see something, like when you just see a piece of land, you're like, how does it make money? You're like, well, the neighborhood, everyone around is buying property here. There's new coffee shops, there's new buildings and malls and hotels being built all around here. The land is appreciating just because of everything else going on. And that's what you're seeing with these digital rent and digital credit, depending on if you're the issuer or if you're the purchaser. Um, what you're seeing is this financial engineering is becoming more tangible and visible. Therefore, it's you have to use less imagination because now it's right in front of your face. It's hitting the income statement now, right? Like you don't have this, oh, it's just going up on paper kind of thing. No, it's flowing through your business now. It's hitting your bank accounts, and now the lenders are going to see it show up. And I think that there's going to be a huge boom in digital finance. We've seen everything go digital. We've seen just like everything in life go digital, from the email to like websites, and now it's like the era of digital energy and digital finance. And I just get really excited when we're talking, Garrett, because like I said, you're one of the few people out there that really understand this and can articulate it. I think you do a really nice job of just summing it up and making it digestible for people to understand. So I'm super glad that you were able to come on, and hopefully you can join us again. And I don't know if Chris and Garrett, if you guys have any closing thoughts here.
Yeah, I mean, I echo everything Kenny's saying. I really appreciate your time today, Garrett. This was really, really helpful and really insightful. And as far as some takeaways or some action items for commercial real estate owners, from this conversation is, one, be proactive with your insurance, whether it's on an existing asset or you're acquiring a new one. Start the renewal process well in advance. Shop multiple providers so you have that that hedge, so to speak. And I think the biggest thing I got from what you were saying here today, Garrett, was be organized and be prepared, right? Be able to tell a story, an organized story about your property, right? Here's the tenants, here's the pros and cons, here are the additional income streams. Make sure you go to your insurance provider with the work done for them. That is going to make your process of insuring or renewing your property insurance that much easier.
Yeah, I'll double click on that from an insurance broker's perspective, where I've done this for 26 years. When you start to scale and get big as a commercial real estate project, the personal relationships you have with your insurance carriers just grows in importance, because it usually just morphs into, it's not a question of if you're going to have a loss event, it's when. And doing this 26 years, like the amount of losses that are clean cut and easy to negotiate in an insurance contract rarely occur. So you're almost always dealing with some kind of covered, not covered situation, partial coverage, some exclusion that kind of kicks in, or some kind of gray area. And those relationships really, really matter. And then having an insurance broker partner that, one, understands your business, understands where it can go, understands there are, as you scale, a lot of companies do their own self-insured captives. So there is a point in time where your business is better off. You can insure yourself through a captive, and there's a whole host of tax advantages and kind of long-term thinking advantages you can do on these kind of alternative risk structures. So yeah, don't be, insurance is not a black box, and there's a massive amount of opportunity to kind of squeeze the levers and do things if you're just willing to go through the process.
Is there any place you want to, before we hand it over to Tim to sign us off here, do you want to point the people in cyberspace anywhere to find you?
Yeah, I mean, easiest way to get me is LinkedIn and X. My X handle is @GarrettOJ. And then my LinkedIn, I think, is just Garrett O. Johnston. But garrett.johnston@marsh.com is my email. If there's anybody that wants to have kind of a deeper dive on the insurance side, happy to do it. Over to you, Tim.
Awesome. Garrett, thanks for joining us today. That's it for today's episode. If this conversation was useful, please share it with a partner, a client, or somebody that's a decision maker in the marketplace. New episodes drop weekly. For Kenny Alves, Chris Drizga, and Garrett Johnston, I'm Tim Kotzman. Until next time, stay disciplined, think long-term, and stack sats. This is the Real Estate Standard. Thanks, everyone.